This last video for segment 1-3 takes up options. As we mentioned in the opening video, options give the holder of the option a right but not an obligation to transact. The owner of a call option has the right but not the obligation to buy something. He has the right to call that something from you for a particular price. A put option, if you sell me a put option, then I'm the owner of that put option, and that gives me the right, but not the obligation, to sell something to you at a specified price. And that something can be an asset, a commodity, or an index. Now, an option premium is the price you pay to buy an option. Now, if you think about it, if I have the right to transact as long as I'm going to make money, and the right not to transact if I'm going to lose money, then this is a security with a non-negative payoff and possibly a positive payoff. That's worth some money, so I'm going to have to pay for that right today. The price that you agree to transact at with a call or a put option is called the strike price or the exercise price. There are two types of options. There's an American option that lets you transact at any point in time up to the expiration of the option. So if the option expires in 3 months, you can exercise that option any time between the time you purchase it and the time it matures in 3 months. If it's a European option, then you can only exercise that option right at expiration. Options differ from futures in two main ways. First, as we've mentioned before, options do not come with an obligation to buy or sell the underlying asset. If you buy a futures contract, you are committed to buy that asset at some point in the future. With an option, if the transaction is not in your best interest, you can forego it. Option buyers pay a price for that right, and that's the premium. Whereas when you enter into a futures contract, the futures contract is specified such that the expected value of that contract at the time you enter it is zero, so no money changes hands in a futures contract when it's consummated. The potential gains from call options come from price increases. So if I buy a call option, then if the price goes up, and if it goes up far enough, I'm going to make money. Let's put a numerical example on this. Suppose I have a share of stock that's selling currently for $50, and I buy a call option on that stock with an exercise price of $50. And let's say I pay $2.50 for the premium for that call option. Well, I'm going to make money as long as the underlying stock price goes up past $50 plus $2.50. So if the stock price goes higher than $52.50, I'm going to realize a profit. The best case scenario from buying a call option, the stock goes up forever and I make a ton of money. The worst case scenario, if the stock goes down after I buy it, I lose my premium. If I sell a call option, the payoffs are the exact opposite. My profits from selling the call option increase as the stock price decreases. So let's go back to our share of stock selling at $50 with an option selling for $2.50 on that stock with an exercise price of $50. If the price goes down from 50 at the time I sell my call option, then the holder of that option will never exercise it and I'll capture the full premium. However, if the stock price starts to go up after I've sold the call option, then I'm going to lose money. So if the stock price goes up over $52.50, I'm going to start losing money dollar for dollar for every increase in the stock price. So theoretically, my losses from selling an option are unlimited. If I buy a call option, I realize nonlinear payoffs. My losses are limited. They cannot go below the premium that I pay. My gains are unlimited. Put options are a little bit different. With a put option, If I buy a put option from you, that gives me the right to put whatever that asset is to you at a specified price. So if the price goes down, then I can make money. So say, let's return to our share of stock selling at 50 bucks a share, and let's leave the premium of that option at 250 and the exercise price at $50. So I'm going to pay you 250 for the right to sell you this share of stock for $50. Now if the stock starts heading down after I buy that put option from you, say it goes down to $45, well then I can sell that share of stock to you for 50 bucks and turn around and go in the market and buy the share for $45, and I'm going to make $5 on the deal. So when I buy a put option, the best case is that the market price goes to zero. I can make, in the example that I just gave, I can make $50 if the price of that stock on which I purchased the put option goes from 50 to zero. The worst case, the price goes up, I lose my 250 premium. Now if I sell a put option, now I'm going to profit if the price increases, because if the price increases, you're not going to sell your shares to me at a lower price. So the best case from the perspective of a seller of a put option is that I collect the entire premium. The worst case scenario is that the market price goes to zero. So in case of a put option, the gains and losses are limited for both buyers and sellers. Let's take a look at the option quotes for Nike shares. So I pulled these price quotes on January 17th after the close of the market, and we're looking out to January of 2014. So these options are good for 2 years. Now I can buy the option to call Nike from you for $60 a share for $35.30. Clearly Nike is already selling for well above $60 a share at this point in time. You can see as the strike price goes up, the option premium goes down because it becomes less likely that the option is going to close with the price of the Nike being greater than the exercise price. Now the one thing I do want to draw your attention to is recently the ticker symbol for options has changed to give more information to the option buyer. So you see the ticker symbol for the underlying asset, you see the year in which it expires, that's 2014, you see the month, that's January 001, and then you see the day, that's the 18th, and then you see just the code for that particular option. So this is new information over the symbol that was used in your textbook. Let's see how investing in stocks versus options changes. So let's start with stocks first. Let's suppose you have $10,000 to invest and you want to invest in Macron Technology and it's now selling for 50 bucks a share. So how many shares can you buy? Well, you take your $10,000, divide by $50, and that gives you 200 shares. The payoff to this position, well, let's suppose Macron goes from $50 to $55 per share in 3 months. Well, then you're going to be able to sell it for $55 times 200 shares. That'll be $11,000. You pay $10,000 for it, you make $1,000. However, what if Macron goes down $5 a share over the next 3 months? So it drops to 45. You're going to sell your 200 shares at $45 a share. That's $9,000. You paid $10,000 for those 200 shares. You lose $1,000 on the deal. So suppose instead of buying $10,000 worth of stock, you were to buy $10,000 worth of options on Macron Technology with a strike price of $50 maturing in 3 months. The premium for this option now is $4 a share. So at $4 a share, there are 100 shares per contract. You can buy 25 option contracts on Macron Technology. So how do we get to that point? Well, Each contract is for 100 shares at $4 a share, so it's going to cost you $400 per contract. You have $10,000 to invest, so you divide the 10,000 by 400, and that gives you 25 contracts. Now with 25 contracts, you are controlling 2,500 shares. Notice in the previous example that you were controlling 200 shares. So options offer a tremendous amount of leverage. If you buy the shares outright for $10,000, you control 200 shares. If you buy 25 contracts of Macron Technology options for $10,000, you are controlling 10 times and more shares. So let's take a look at the payoffs to this option contract. Well, suppose Macron goes up and is selling for $55 a share in 3 months. Now your gain is going to be $55 a share less $50 a share. So that's $5 a share times 2,500 shares less your $10,000 investment are $2,500. So for the same increase in price from $50 to $55, instead of realizing a $1,000 return, you realize a $2,500 return. If Macron goes down to $45 a share in 3 months, well then you're not going to exercise your option. So now here comes the downside to options. So you invested $10,000 in these 25 option contracts. You're going to get nothing in return. You then eat that entire $10,000. So sure, you have leverage on the upside because you're controlling more shares, but if the shares go down, you lose your entire premium paid. This is just a listing of the wide variety of internet sites that offer just an unbelievable amount of financial information. So I would urge you to click on each of these links and see what information is available, and almost all of this information is available for free. So let's review what we've done in segment 3 of Unit 1. Well, first we began by looking at interest-bearing assets. These are money market instruments, instruments with maturities of less than 1 year that typically sell at a discount. We also look at fixed income securities. Typically these are notes and bonds. They have maturities greater than 1 year. They pay a coupon based on a percent of the face value. Typically they pay the coupon twice a year. Then we looked at equities, common stock and preferred stock, and we looked at how the prices are quoted on the Wall Street Journal and on yahoo.com. Then we looked at derivative securities, futures contracts, and futures price quotes, and considered the gains and losses on futures contracts. And then lastly, we looked very briefly at options contracts, some of the terminology involved. We looked at the payoffs on options versus the payoffs on futures. And we looked at the price quotes and the gains and options on and the gains and losses on option contracts versus investing in stocks alone. That wraps up segment 1-3.